Hi there, and welcome to this free webinar on how you can get your first mortgage. It is basically free training for you that will answer all your mortgage questions that you may have. If you are just looking for information, general information of how you can get a mortgage and you're inquisitive about that, this webinar is for you. Alternatively, if you are looking to get an application form approved in principle ASAP, this will also answer all your questions. So that's kind of the rundown. I just want to go through the basic outline of the webinar. So the first thing I'm going to go through is we're going to go through all the common misconceptions out there in relation to mortgages. As I'm sure yourself, you probably had a few things out there that when you watch this webinar, you will go, wow, I thought completely different about that. So we'll go through that. The second thing we'll go through is we'll go through the general rules in relation to applying for a mortgage. For example, how much money I can get, the savings I need, the typical documents I would need for a mortgage application, and we will show you how to the quickest and easiest way for you to get mortgage approval. The third thing they will do is go through the do's and don'ts in relation to applying with your mortgage application and show you how to clean up your bank statement so that you don't be putting a mortgage application forward and it gets declined because something comes up in your bank statement or something that you could have cleaned up before you put it in that stops it. We will make sure that never happens to you. Finally, we will go through the government incentives that are out there that you may qualify for. For example, the Help to Buy incentive, and there's another other lending facility out there that is new on the market. So we'll go through these two facilities with you in detail and see whether you qualify for them. So that's kind of it. The format that I'm going to use here is I'm going to use a PowerPoint presentation which will go through, explain in detail all the data, the information that I need. So we'll just go straight to the presentation now. Okay guys, I'm just going to use this presentation here, as I said before, to explain everything. So the first point that I want to go through here is the general misconceptions in relation to mortgages and kind of financial jargon out there that people that similar to myself, as I said before I got into this industry, this is what I thought about a lot of stuff as well. So I'm just trying to answer any misconceptions that are out there that you may be thinking. The first one is that you have to use your current bank that you're using all the time with your money to get a mortgage. That's not true. This is what I thought myself before I applied for my first mortgage, that the bank you use is the only bank that is there for you to apply for a mortgage. That's not true. You can apply for a mortgage for any bank out there or any financial institution. You don't need to have an account. You probably have to open one eventually, but you can apply to them all. So that's the first one. Like that as well, just with banks, you can always shop around. I think an awful lot of people in Ireland especially, you might set up a bank account in your national school or secondary school with a certain bank and you stay there for the rest of your life with them. Even if you have a mortgage with one bank, you can very easily switch mortgages for a better deal. There's a lot of good deals out there for people now with reduced interest rates and maybe cashback options there for you on a switcher mortgage. So that's there as well. It doesn't apply to you, but maybe down the line it does. But just to fill you in on that is there. We will cover that. We will cover the deals that are there as well later on in the presentation. But another thing is, which is a very strong one, is the bank knows best. And stay away from independent financial advisors. I thought this myself as well a few years back. But if you just think about when you go into a bank manager, into a bank, you presume that he knows best, he knows everything. But if you think about an independent financial advisor, is on your side. He wants you to get the mortgage just as much as you do.
and he'll help you put, or he or she, sorry, will help you put your best case and the best picture of yourself forward in your application, and organize your application prior to going into the bank. And he will represent you, or he or she will represent you on your behalf to the bank. So basically, when you sit in front of an independent advisor, they'll go through everything that you have. They will, phrase things differently so that you can portray the best picture of you to the bank in your application. You don't have to go meet the bank at all. And as well, the independent financial advisors then you have more choice with these guys like with independent advisors, because they can apply to all the different banks, and then you can go back and you might have 3 or 4 options, and you'll be able to make more choice, and you have a better chance of approved by doing this. If you go into a bank and you say something wrong that you shouldn't say, or say it in the wrong way, that's on file. It's there. It can never go anywhere. So if you get declined because of that, you have to wait 6 months again before you get it back. Whereas if you kind of go to an independent financial advisor, you can. It's kind of like a dress. Rehearsal for the real thing, as well as that you don't have to go in and sit and feel vulnerable in front of a bank manager. The independent financial advisor will do that for you, or submit your application for you. It's that's an important point on that. Low interest rate means the best deal. I'll go through this again in later modules. But this is, people are always very competitive. The banks are very competitive on rates. But sometimes, you get cashback deals, and there's other deals that are in the package that over the term of the policy will make it a cheaper one for you and a better deal for you. So it's at first glance you might think that that's the best deal, but when you do the number crunching, it may not be there. So that's what an independent advisor should be able to do for you: analyze the whole market so that you get the best deal possible. This is another thing, I suppose, that personally I kind of felt before I applied for my first mortgage. I'll never get a mortgage. There's no point in trying. Probably a lot of you guys watching this are paying huge amount of rent, and you're going, oh my God, I just can't get out. I just don't feel like I'll ever get out of this. Or, I don't feel like I'm good enough, or I have enough money to do this. But that's only a mindset you just have to get yourself out of. Of course you can do it. Like some people think then, oh geez, if I get a mortgage, will I be able to pay back the repayments? I'm paying whatever, €600 a month now. What if I get a mortgage and my mortgage payments are €1,000 a month or whatever? At the end of the day, you can always look at it as an investment. You can rent out 1 or 2 rooms in your house, and basically half your outgoings. Like, let's say, for instance, if you were paying €600 a month now in rent, and then you got a mortgage and the mortgage was €1,000, you could rent out 2 rooms, and for €400 a month each, that's 800. So your outgoings per month would only be 200. You're cutting down on your rent. So that's there. It's just about thinking like an investor instead of thinking of, thinking about your repayments. So that's something that kind of I had to get my head around myself before I got my first mortgage. And then when you're in it and you get your mortgage, you go, geez, why didn't I do this before? So as I said, if an older me if me now talked to a younger me at 24, 25, I would have been saying, get out there, get yourself mortgaged and get a property. But it's just the mindset. At the time, I didn't feel like that's what I should be doing at that age. But there's no real, best time to be getting a mortgage. So, now, why not now? Never be able to further up on the payments. I cover that point. This is another thing, yeah, like there's, people always think, I used to think, oh geez, a mortgage means you're settled down, you're married, you have kids, and you need to get a mortgage. It's kind of like a mortgage is forever and all that. You should just think about it like an investment. If you're 24, 25 years of age and you have a secure job now, get out there, get a mortgage. You could get a pretty cheap house. If you're lucky, if you search the market, apply for a mortgage, get approved, go house shopping. If something comes along, buy it. Who knows? You could sell that in 3 or 4 years' time and make 50, 60,000 on it. You'll be a long time working to get that money back. That's what investors do to make money. And then all of a sudden you have a deposit for a bigger house going forward, for your right house, we'll say. You're the one that you're going to live in forever. So, just kind of change the way you're thinking would be my advice on that. So the next thing I'm going to go on here is first-time buyers. So what is a first-time buyer? So to qualify as a first-time buyer under the central bank rules, you never can have bought a property in your own name before. Or if it's a joint application, there's a partner going to the partner, neither of you can have a property in your own name or bought a property or have a mortgage in your own name before. That's very important. So you can't have a property in your own name before, or you're not a first-time buyer. But if you are, these are the general rules. I just go through the general rules, and like this, I mean, before I got my first mortgage, this was gobbledygook to me as well. So don't worry, I'll explain it all correctly for you here now. So applicants can only borrow up to 90% of the purchase price of the property. So this means that if the property is worth 200,000, then the mortgage provider will only offer a maximum mortgage of 90%, which is 180 grand in this example down here. And you personally will have to pay the 10% deposit of the purchase price. So if you just look at it here now, the 90% loan to value. This used to always confuse me before. So what loan to value is? You hear this kind of financial service jargon, loan to value. It's like, I don't know why people use it. It's just stupid, really. But, so what it is like it's 90% loan of the value was what the mortgage will give you. So loan to value. So the value of the place here in this property is 200,000, which is 100%. The bank will give you 90% of the market value or the purchase price of the property. So that's 180,000. So then, as a first-time buyer, you only have to come up with 10% for a deposit, which is 20,000. So if you weren't a first-time buyer, this changes. You only get 80% of the purchase price of 200.8. So if you were a second-time buyer, the bank will only give you 160,000 for this, and you've to come up with 40,000 of a deposit. But because you're a first-time buyer, it's beneficial for you. You've only have to come up with 10% of your own money to get a 200 grand property, because the bank will give you a mortgage of 90%, which is 180,000 in this example. So this is different now, guys, if it's a new build, if you're building. So this is maybe for someone who is building on your home property, your home land at home, or you've got a property cheap out the country of someone and you are building yourself. So what the banks will give you here, they will give you, it's the lower of these two options. Number one, 100% of the cost of building the house. So if you're out the country and you got a site and you were going to build, it's going to cost you 150 grand to build the site. That's what the mortgage, that's 100% of the building of the price, or 75% of the market value of the house. So whichever is the lower of these two, that's what the bank will give you. So I'll just use, I will compare the two here, because as I said to you, I used to get confused with this. I used to, really confuse me. So hopefully this will explain it better for you. So this is the way, if you're buying a house, example I had before. So you have a 200 grand property you're going to buy. The bank will give you 90% loan to value, 90% of the loan, and 10% is what you have to pay. So they will give you a mortgage of 180 grand. And you will have to pay 20,000 yourself at this 10%. But if you were building a property at home, for instance, you will get a mortgage of lower of 100% of the build. So let's say, for instance, we'll use a house at 200,000. So let's say, for instance, you will get the lower of 100% of the cost of building the house. So let's say that is 175. So you're going to build a house at home and it's going to cost you 175. So it's the lower of this or 75% of the market value of the house. So let's say this house at home is worth 200,000. You were to sell it in the morning after you build it. So the mortgage provider, the bank, will give you 75% of the market value of the finished house build, which is 150,000. So on this example, it's going to cost you 175 to build, but you 75% of the market value of the house when it's finished is 150,000. So this is the one that they will give you. But I suppose if you look at the different, so what they're really saying there is that the bank are really saying is that the site, you probably got the site for, if you probably got the site free if you're building a home, or at a very low price from, let's say, if your dad. So they're probably saying that, okay, the site is around the 50 grand mark or in around that. So this is the way that you might think, oh geez, I have to cough up with 50 grand here as a deposit because they're only going to give me 150. But that's not the case really. The bank kind of use the site as nearly like a deposit, so you don't have to have as much money as 50 grand to put together as your deposit. So again, it's all by individual basis, but we can chat you through that if you want, but they are the option. So it's 100% of the cost of the build or 75% of the market value of the house after it's finished. It's the lower of these. That's the mortgage you will get from your financial institution. So hopefully I explained that well. If I haven't, you can just private message me at any time here and I will go through any example that you have. Okay, this is another big one that we all want to know. We all want to know, okay, what can I borrow? If you're out there and you're only inquisitive about about getting your first mortgage, what can I get? So the rules is that I can get 3.5 times my gross salary. So your gross salary is basically before you pay tax. So, and a lot of people, I remember before I started working in this industry as well, everyone kind of goes on, okay, you say, what's your gross salary, your gross annual salary? And they'll go, oh, sure, it's, I don't know, but I'm getting whatever, 2,300 euros into my bank account a month. That doesn't matter because you could be getting expenses with your company if you're a sales rep, or you could be getting bonuses. You cannot count these. You can only count your gross salary. What's on your gross salary? On your P60, your gross salary, it's the left-hand side of your pay slip usually. That's what it goes on. And it's 3.5 times that you have. If you're a joint application, yourself and your partner, it's 3.5 times both gross salaries. So it's important to know that people kind of don't really understand that as much. So I'll just use an example here. So let's say, for instance, example 1, we'll call teacher John. John is on 50 grand gross salary. So he can get 50 grand by 3.5 times 175. That's the mortgage amount he can get. Okay? Example 2, let's say a joint application. So John is on 50 grand and his wife, Mary is a sales manager and she's on 45 grand. Plus, she gets a 5 grand bonus and expenses over the year as well. This cannot be counted, guys. You can only count your gross salary. So 50 by 45, 95 by 3.5 is 350,000. That's the size of the mortgage that this joint application will get. So hopefully I explained that well. Secure income, guys. If you are an employee and you need a secure income, and it has to be the same employment for 6 months. Usually you have to be on a permanent contract. So that's you really do need that. If you're jumping from job to job, they look at it as you don't have a secure income, and you will be riskier. You are riskier than a guy who has, and you may not be able to pay your mortgage repayments if you get the mortgage. If you're self-employed, like a plumber, tradesman, solicitor, sometimes accountant, whatever, you're going to need 3 years audited accounts. Now that is pretty, that is not easy there, because if you're, let's say, even if you're a self-employed person, you start off and you're absolutely flying with your business, but you're a one-man band, you're self-employed, you still need 3 years. It's harder to get it. Now, it's not impossible, but they're the general rules that the banks look for. Proof of repayment capacity, very big here. So here you have to have regular savings and rent repayments to show that you will be able to meet the repayments. So let's say, for instance, if you apply for a mortgage, a 200 grand mortgage, and the repayments are 1,000 a month, you have to show to the bank through regular savings and rent repayments that you're doing right now that you can live a normal life and that €1,000 between these two will be enough to cover your mortgage repayments. So that you're not going to be dipping in, and you won't be pushing the sailing too close to the wind if you have to pay €1,000 a month. So, like, let's say, for instance, if your mortgage is 1,000, they'd be looking to be going, right, okay, if you've regular savings of 500 and your rent repayments are 500 per month, that's €1,000. That are kind of more or less in and around. That's a rough figure now, but that's kind of what they're looking for. So they show you repayment capacity for the mortgage repayments. Sorry, just on that, we will go through few do's and don'ts in relation to this in the further on the presentation. Here, a good track record, very important here, and this is a barrier to a lot of people. So you need a good clean ICB. ICB is an independent credit check. Okay, so this is a kind of it's an independent credit check, which basically means that all your lending or your credit history can be generated on one report, which goes back to 5 years, and it rates your credit, your record over the last 5 years. So if you have a bad credit rating, you're missing repayments in your credit card, you have missed mortgage repayments, or certain direct debits with whatever it is, loans or short-term loans, whatever. This will all show up in your ICB. So there's actually no hiding from that. This is an independent credit check. It's not with the bank. It's an independent one. You can actually run this an independent credit check yourself on the website. You can mail us if you want, and we'll send you the website address. It costs €6.50 to get a credit check done on yourself, so you can see your own credit history, what the bank will be looking at themselves. So you can't really have any missed payments on a credit card or loans, and it goes back 5 years. So now look at. They usually want a good, clean ICB. Now, there may be ways around it. That's why I suppose an independent financial advisor is good to go to, because there may be ways around it. But in general, you need a kind of a pretty clean ICB to be approved for a mortgage by a financial institution. Okay, next one is proof of funds. So funds are needed to cover the following. 10% deposit. You need actual proof that this is in your savings account, the 10% deposit, before you will actually be able to draw down your mortgage. There's 1% stamp duties. That's 1% of the purchase price of property. Let's say if you buy a property for 200,000, so you will have to pay 2,000 stamp duty on that. You have legal fees and valuation fees. They vary from 2,000 to 4,000, I suppose. So this is it. So the bank will kind of, along with your 10% deposit, you will probably need about another, 5 or 6 grand easily. It depends on the valuation of the property along with it as well. So it's important to know that. And you will need an actual copy of the bank statement to show the balance showing for this, or they won't accept it, really. You can't just say, oh, I have this and I don't have it. You need to show that it's in your savings account somewhere. Okay, right, guys, documents required. So this is just to give you a general rule of thumb of the stuff that you will need. This, for your application, you will need a valid passport, driver license, utility bill in your own name and address. It has to be within 3 months now, guys. If it's over 3 months, it's out of date. You need 6 months current account statements. You need 6 months savings statements. 6 months credit card statements if you have a credit card. 12-month loan repayments if you have a loan. You need 3 months recent pay slips. And you need your current P60. So these are all the documents you need. So when you're doing your application form, these are the stuff that you need, the documents that you need. Okay, guys, just on this cleaning up your act. So basically, this is where we will, when you come in with an independent financial advisor, or anybody really, you need to clean up your act prior to submitting your application. This is very important to ensure that you do get approved in principle on your first go. So these are certain things that you need to do. So This is very important, guys. No gambling on your transactions on your current account, because as I say, you're going to have to give 6-month statements to the bank, okay, with your application. If they run through it and it shows that you were gambling, or you have a Paddy Power account, there's money going in and out of your transactions, that looks like you're not trustworthy in repaying, and that you may default on your mortgage repayments. They look very unfavorably of this, the bank. So if you do like to put a few pound on, I don't know, soccer games, accumulators, or whatever it is, whatever your hobby is, you cannot have it going through this account. So set up another account, whatever you do, but it can't go through this account, or it's like a red rag through bull when you bring it to the bank. So that has to stop, guys. Set up another account if you want, but your current account statement has to be clean. Overdraft facility, stop using your overdraft facility. If you have one, stop using it. Again, it's about repayment capacity. It shows that you're living above your means if you cannot use it. Even though some people just use their overdraft like it's your own money, it's just probably a bad habit. You need to clean this up before you put in your application or with your 6-month bank statement. It's very important there as well. Start saving on a regular basis. Very important for repayment capacity. As well as that, guys, a lot of people start going, oh yeah, I pay, and they're going into the credit union or the bank and they manually put in money, different amounts every month. That's not as effective as if you put in a standing order of a certain amount every month for a 6-month period. That's what they want to see. So, and as well as that, guys, we've had a case there lately where there was a couple that were putting in an awful lot. So let's say, instead of putting in 500, they were putting in 900 a month. But they were going in every second month and they were taking out money out of their savings. So in the bank looked at that as if they're living within their means. So you're nearly better off to be putting in an amount that you're not going to touch for 6 months, that you're not going to be pulling out of your savings. That's a complete no-no, because the banks look really unfavorably at that, and you'll have to go back and prove that you can live without that money for 3 months. So it needs to be regular, it needs to be a standing order. So that's a very, very important point. At least one standing order direct debits, that's the best way of doing it. Do not put it into the savings, as I said to you before. Next one is not missing any direct debit payments. So for anything, they will look at your current account statements and they will see unpaid direct debits for any bills and your current accounts, utility bills, subscriptions, whatever. It's just try not to have anything bouncing for the 6 months in your statements, because they're going to scrutinize your statements over a 6-month period. Another thing, this was one that I found myself personally before I went in for my first mortgage. I used to pay my rent by cash, so the landlord would come around and I would pay him cash. But for the bank, it's an awful lot harder to prove that you are paying this amount for repayment capacity when you're paying cash, because you're going into the ATM machine, you're taking out a certain amount. So let's say, for instance, your rent is 500, you might take out 700, and then you might be only taking out 400 the month after it. So it's harder to prove to the bank. So if you haven't already, set up your rent on a direct debit basis so that when you print out your statements, they can see, okay, right, 500 euros going out every month for the last 3 or 4 months. So that's proof of repayment capacity. If your credit card bills ASAP, guys, make sure, or at least be repaying it monthly. Don't be missing any payments, even if it's small. I made this mistake myself. I paid off my credit card. I had a couple of grand on it, and I paid it off when I was after college. I paid most of it off. There was only a couple of hundred left in it, and I wasn't paying these bills. There was only like interest of like 10 quid or 11 quid. That still can affect your rating. It shows up in red for the bank. So whatever it is, if you can at all, even if it's only small, pay the goddamn thing off. Get it out of the way. Or if not, at least put a regular plan that shows them that you're in control of it. So that's very important. Okay, right, guys. This is getting approval in principle. Okay, this is a misconception out there of approval in principle. So what does that mean? So getting approval in principle for a mortgage. So this is basically you put in all your application. If you're using an independent financial advisor, he puts it to all the different banks to see what and then he come back with you with all these different choices. But getting approval in principle only means that you have the option of drawing down your mortgage. So it is like getting permission to go house shopping. So let's say, for instance, you are on 50,000. 3.5. So let's say, for instance, you are going on it alone and you're on 50,000 gross. You want 3.5 times your salary. Always go for the max because you don't have to draw it down. So then you can go, right, so I have 175,000 of a budget that I can go and house shopping with. So then you can go out and you can go house shopping. You have 6 months usually to draw that down whenever you want. So let's say, for instance, you buy a house for 150,000. Then you only draw down that amount. You don't be drawing down 170,000. But approval in principle is just like permission to go shopping. You have all the red tape, all the paperwork done. Then it's time to go shopping. So apply for the max, get approved, because you can always come down with it. Okay, guys, I just want to cover a small bit on mortgage interest rates. There's a lot of stuff out there in the TV and newspapers, daily bank ads about, what bank has the best deal and the lowest rate and all this kind of stuff. But it's kind of confusing for you guys because you have to really do a bit of number crunching to find out which is actually the best deal over the 30 or 20 or 30 year period of your mortgage. So all rates difference from your loan to value. So, if you are a first time buyer or a second time buyer, the rates differ. So just want to be aware of that. So all the rates differ between banks. So that's kind of the independent financial advisor's job to kind of do the number crunching for you and tell you, okay, this is the best rate for you. So that's why kind of it's important that you use an independent financial advisor that will go, okay, right, this bank offers you this and he offers you cash back of this and this. This other bank has a lower rate, but over the period of time, this is what you're going to pay, blah, blah, blah. So you have more choice. So as I said, lowest rate does not necessarily mean you have you're going to be paying the least amount. So just for instance here, some of the banks give fixed rates, they give variable rates. So variable rates go up and down in line with the European Central Bank, etc., and this what rates the central bank are paying. So fixed rates, then you can tie yourself in for 1 year, 2 year, 3 years. So I'm just looking at this example here. There is sample variables available, so like 2.95, 3.15, 3.15, 4.5. And then you have the fixed rates available here of 3.2% for 1 year, 2 year fixed rate at 3.3, 3-year fixed rate of 6. So after these years, then you go on a variable rate usually. So it's a way of tying in, if you're kind of pretty tight and you want to guarantee that this is the repayments you're going to make, fixed are the way to go. If not, if you think the rates are going to stay low, this is the way to go. And as well as that, guys, you have to tie in the cashback options that are being offered by the banks. So when I say a cashback option, guys, let's say, for instance, like what they do, when you say, for instance, some of the banks will say, okay, we'll give you 2% cashback once you draw down your mortgage. So let's say, for instance, if you have a 200,000, we'll divide that by 0.02. So let's say, for instance, if you get a 200 grand mortgage, you will get 4,000 quid in a lump sum payment when you draw down from the bank as a cashback. So you get 4 grand there you can spend on the house, whatever. It's actually nice. I did it myself. So it's pretty good. And some of the banks are now offering an extra 2% cashback on the monthly payments. So like there's a lot of deals, and I suppose like I'd say even by the time you see this webinar, or there's probably another deal going out there because they're very, very competitive. They're always changing. So I'll just give an example here. Mortgage 250 for 25 years. So then I'm just comparing one that gives cash back and one that doesn't. So if you look at the Bank A and Bank B here, so Bank A has a 3.2% interest rate, Bank B has 3.3. So you would think, okay, this is the best deal to go with, but they both give the 2% cash back. So you both get your 250 multiplied by 0.2. So you both get your 250 times 0.2. €5,000 when you draw down a mortgage. Plus, bank B give you 2% on a monthly cashback every month. So the repayments here, first off, is 2,111, and this is 2,224. So you're going, okay, this is better. But when you filter in the 2% cashback that you're going to get on a monthly basis, which is 24.48, the repayments are 1,199, and these ones are 1,211. So this one is actually more when you do the number crunching. So again, and just use it in an illustration, the financial advisor should do these number crunching things out for you and relay it down in actual monthly cost to you, and you can make a decision on that then. Okay guys, next thing is a very important thing. It is the government incentives that are out there for first time buyers. This is a very important one. It is the government help to buy incentive. Okay, this helps you get a deposit together for your house if you're a first time buyer. So it is really, really, really beneficial for you guys, and it's crazy for you not to do it. So it's for first time buyers only, so you have to be a first time buyer, and it's only for newly built or self built properties built on before 2016 and things. So if you were buying a property that is a new build, so let's say you're buying a house in the city that's a new build, you qualify for it. But if you were buying a property that someone lived in before, you don't qualify. If you're a self-build out the country, you qualify. So what it does is, you know how we said if you're a first-time buyer, you have to have a 10% deposit. So basically, you can get a 5% of the purchase price or the complete value of it with a maximum of 20 grand. So let's say, for instance, if you have a 200 grand mortgage, and so that means that you're going to have a 10% deposit, which is 20,000 quid. So you can actually, so this government incentive, if you are a new build or it's a self-build, will give you half of that 20 grand back from tax and dirt that you have paid over the last 4 or 5 years. So you will get 10,000 euros back from the government to cover the 20,000. So you only really have to come up with 10,000. It's a really, really, really good, if you qualify, it's absolutely fantastic incentive. So if you qualify, first time buyer, new build, or self-build property, get on to us. If you go onto our website, we will show you how to apply for it. It's very easy to apply. You apply to the government, and they give you back the money. So it's a really good incentive. Another one in here, guys, is this one, which is relatively new out, is the Rebuilding Ireland Home Loan. And what that is, it is a fixed interest rate loan provided by your local government authority. For first time buyers only, you have to have an income of 50,000 or less if you're single, and if you're joint, it has to be under 75,000. This is a big one as well. You have to be declined twice by the bank. So if you have a bad ICB credit rating, this is for you, and it goes up to 90% loan to value. And the maximum market value of the house has to be 250,000 or 320,000, depending on your area. This is usually in the city. But guys, if you qualify for this, the interest rate that's charged in a loan is a lot lower, and your repayments could be a third or half than a normal person would if you went through the bank. So if you qualify for this, it's really, really important that you put your application in and get it in and get this type of mortgage, because it is very, very, very good for you. Again, if you go onto our website, mmadvisors.ie, I will put it up at the end of it, and you go to our products page, there is a form in here if you want to apply for any of these government incentives, and you can just send it off yourselves. You don't need to talk to anybody. But this is just to give you a bit of knowledge on the area. Okay, that's basically it, guys. I will just come back off the PowerPoint now, and I will talk to you in front of the camera now in a second, just when I get set up.
Okay, guys. We've covered a lot there in that presentation. Hopefully I explained everything okay for you and you understand everything. If you've any questions or queries since you've watched the webinar and you want me to clarify anything, you can just email me or give our office a call or contact me on social media. We'll flash up the details at the end of the webinar if you want, and I will get back to you, or one of the guys in the office will get back to you, or else I'll get back to you and clarify any issues you may have. So now, guys, now it is time for you to take action. So whether you are just inquisitive about getting a mortgage to see, whether you would get a mortgage or how much you would get, if you are thinking of buying a house within the next 12 months, or alternatively, if a property has come up that you would like to buy and you need a mortgage ASAP, you should take action now and click on the button below and fill in a few details, and we can then assess your results and give you answers on how much you can get, whether you would get approval quickly or whether you need to clean up your act to get approval as soon as possible. And just remember this, guys, applying for approval in principle doesn't mean anything much really. It just means that it's given you the option that you can go house shopping. You never have to draw down your mortgage, even if you get approval in principle. But at least you have the option there. So I'd advise everybody, no matter what category you're in there, whether you're just inquiring or whether you need a mortgage ASAP, click on the button below, fill in your details. We'll be able to give you your results back to see how much you would get, answer all the questions, show up anything that will flag that will stop you get mortgage approval. If you want to go forward, then we can put your application forward to the relevant banks or financial institutions that offer mortgage for you. So as I said to you, there's no harm in trying. Time is ticking by. You don't want to be sitting around this time next year going, geez, why didn't I do it? House prices are going up every month. I hear again that they've gone up again in the last month. So, time is ticking by. There's no better time to take action than right now. So hopefully you have got some benefit from watching the webinar. So hopefully you can click on the button below, fill in your details, and we will speak to you soon.